Hi everybody, my name is Griffin Bridgers. This is part 9 of the basics of the generation skipping transfer tax. If you've been following along in this series, we've covered a lot of ground, especially around the basics, and we're going to shift more from kind of a general label of basics to some more intermediate concepts now, but it's going to give you as a practitioner the groundwork to be competent in the GST tax. So from here on out, we're going to really start to dive into some nuances, the first of which is one of the more difficult ones today that we're going to cover, and that's the subject of GST trusts that are defined under Code Section 2632 C3, and we'll dive into some of those nuances as we go along. But before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice. So if you're a visual person, this is going to be a little more difficult to follow along with, just because we have to look at 6 types of trust structures and exceptions, and a few of those we have to look at in great detail. Some of them we have to punt. But to give you the lay of the land, in Part 8, we discussed taxable terminations and taxable distributions, and really looked at those following up on prior parts in the context of how the GST exemption allocation affects those types of deferred generation skipping transfers. So now we're going to dive back to this concept of automatic allocation and look at when it might not apply, in particular if you have a trust that is not a GST trust. So before we get there, it helps to have a roadmap review to start, which kind of ties together some ends that I felt were left loose from prior installments. And that's really that when it comes to the GST tax, there's a certain hierarchy we have to follow of generation skipping transfers, because the definition of various transfers we've looked at can cross over into multiple categories. So you really have to look to the following order to see if a transfer in particular fits any of these definitions. If it crosses categories, then first you treat it as a direct skip if it meets that definition. Next, if it doesn't meet the definition of a direct skip, but it could meet the definition of both a taxable termination or taxable distribution, you have to treat it as a taxable termination. Both of those are significant because those affect who pays the GST tax, if there is indeed one. If it's a direct skip, it's the transferor. If it's a taxable termination, it's the trustee. Then finally, if both those are failed, you have a taxable distribution. And in that case, it's the skip person recipient who's responsible for reporting and paying the GST tax. So all of these are events that generate GST tax, but they're all reliant on automatic or manual allocation of GST exemption. This goes back to the timing issue, that the biggest problem is the deferred nature of GST transfers, especially when a trust is allocated or when a trust is created. So you usually have to look back in time to when the transfer was last exposed to gift or estate tax. At that time, that's when the code calls for automatic or manual allocation of GST exemption, which I want to remind you again is elective. It's not forced. Now, at the time that the transfer is exposed to gift or estate tax, you have either a direct skip or an indirect skip. So the big question here is going to be that if we have an indirect skip, does every indirect skip allow for automatic allocation of GST exemption at the time that it's last exposed to gift or estate tax? And the answer is no. So we're going to dive into a concept called GST trusts, because an indirect skip to a trust that's not a GST trust is not going to allow for automatic allocation of GST exemption. Later, we're also going to look at the fact that with a trust that's subject to an estate tax inclusion period or an ETIP, there is no automatic or manual allocation of GST exemption allowed at the time that that trust is first exposed to gift or estate tax. But it's because down the road there's going to be another exposure time to gift or estate tax, at which point that ETIP closes and there will potentially be automatic or manual allocation. That's a subject for the next discussion. Today the focus is on GST trust, which once again, I want to remind you the consequence of a trust that is not a GST trust is that you cannot rely on automatic allocation of GST exemption. As we'll see, you can manually allocate. It may be a waste of the GST exemption, but generally you can't rely on automatic allocation. If, for example, you fail to file a gift tax return or you file a gift tax return late. So what is a GST trust? So we're going to dive into the 6 specific characteristics in a minute, but you can find these all described in Code Section 2632C3B, which is a little difficult to decipher if you want to dive in. So I'm going to do my best to make some sense of this, but if it doesn't make sense, then the spirit of this type of transfer is that if you have a trust where there's a strong chance that the trust will never be distributed to skip persons, that's the type of trust that's contemplated as not being a GST trust. So to kind of give you the lay of the land, we talked about GST potential kind of being the initial threshold for whether you can automatically allocate to an indirect skip. But even if there's GST potential, that potential can be cut off if you fail these characteristics. So you can have GST potential in a trust that's not a GST trust, but there's no automatic allocation in that circumstance. So we're going to do our best to dive into the characteristics specifically which cause a trust to fail this test and not be treated as a GST trust. The first is a situation where any individual prior to reaching age 46 has the power to withdraw more than 25% of the trust principal, or there's a mandatory distribution of more than 25% of the trust principal. So an example of this might be the older trust you see that calls for a tiered 1/3 distribution to a child at age 25, 35, and 45. In that case, that might not be a GST trust. Another example would be where you have more than 25% of the trust principal that must be distributed to or may be withdrawn by a non-skip person, not taking into account their age, but whether they're living at the date of death of another beneficiary who's more than 10 years older than that non-skip person. So the example here might be a spouse who has a marital trust and is more than 10 years older than the child who's a remainder beneficiary. So you'd hope they're 10 years older than the child if it's a blood relationship. But that aside, the spouse dies and the trust requires a distribution of more than 25% of the remainder of the marital trust outright to that child who's more than 10 years younger. So the consequence is the marital trust is not a GST trust, and you don't get automatic allocation of GST exemption. Now, looking back at the prior 2 events, if you have a situation where maybe there's the child who has that right to get to more than 25% distributed or withdrawn or whatever, if the child predeceases that event or has a general power of appointment over that portion of the trust at their death, then that will not be a GST trust. So going back to our last example, let's say the marital trust terminated at the death of the spouse who's more than 10 years older than the child, and the child predeceases the spouse, but the child's share doesn't go to their descendants, but instead is distributable to the child's estate. That would not be a GST trust. Similarly, if the child predeceased and had a general power of appointment over that remainder that should have gone to them from the marital trust, it would not be a GST trust. Next, on that theme of general powers of appointment, if you have any portion of the trust that would be included in the gross estate of a non-skip person other than the transferor, if the non-skip person died immediately after the transfer, it will not be a GST trust. So let's assume an example where a grantor creates an intentionally defective grantor trust for the grantor's children during life, and gives a child a general power of appointment over a small fraction of the trust. That trust would not be a GST trust. Now, I emphasize small fraction because we're going to carve out a special type of general power of appointment over a small fraction of the trust known as a crummy power or a crummy right of withdrawal. I'll talk about that in a second, and that's not going to disqualify us, as we're going to see. This is really for a general power of appointment that exceeds the threshold for a crummy right of withdrawal, which can create issues, as we'll see later, so we'll dive into that a bit more, especially with a part that's dedicated solely to crummy powers later on in this series. Finally, we have a couple easy ones to check off. We have the fifth characteristic where a trust is a charitable lead annuity trust, a charitable remainder annuity trust, or a charitable remainder unit trust. We'll later discuss some special rules for charitable lead trusts in general, but it's interesting that the charitable lead unit trust is not included in that exception, but if you go to the next exception in the code, it really describes in that next one essentially a charitable lead unit trust. Now, we'll talk about charitable lead unit trusts in general later, like I mentioned, but having tabled those for now, those are the general characteristics that if a trust has those, it will not be treated as a GST trust. So, I want to remind you again that failing the GST trust test here by having any of these characteristics just means there's no automatic allocation of GST exemption of the transferor to that transfer. You can still manually allocate it, but the question is the GST exemption wasted if you do that? That's more of a case-by-case determination for you as the planner or tax preparer or whatever the case to make to determine, for example, what's the chance that down the road maybe a non-skip person might have a part of that trust included in their gross estate, and thus you can rely on allocation of their GST exemption as opposed to relying on the transferors. That's kind of the general theme and spirit behind this and the planning strategy, which is much more nuanced than I can give it credit for right there. For now, I want to just carve back a little bit of coordination with other terms, one being crummy rights. Remember, crummy rights, as I briefly mentioned, don't count. The flush language of Code Section 2632C3B excludes those powers up to the gift tax exclusion amount and assumes that they will not be exercised. So the consequence is that you can have a GST trust and give crummy rights of withdrawal to beneficiaries without failing that GST trust test, which is important because later we're going to find out it may be helpful to rely on automatic allocation of GST exemption for crummy rights that are given to skip persons. Now, moving on from this, GST trusts may be classified as trusts that are subject to an estate tax inclusion period, which is going to be our next subject in this series, but really that just becomes a timing issue where it doesn't bar allocation of GST exemption, it just defers it, meaning there's no automatic allocation up front, but there will be at the close of the estate tax inclusion period. So that's a little bit of a segue and intro to part 10 that's coming down the pike. So what's coming? We'll get into the ETIP next and what effect it has. We'll dive into some of the nuances of GST exemption allocations on Form 709, especially for certain types of trusts once we've covered the ETIP, and the manual versus automatic allocation strategy. We'll also look at the GST tax annual exclusion and how it's affected by crummy powers, as we introduced here, and certain types of lifetime indirect skips. We'll dig into valuation a bit more, and then we'll finally cover some specific types of trusts like grandfather trusts and gallo trusts that, depending on when they're set up, may be exempt from the GST tax. And then one item that's not on the list that we're going to add that will kind of be the bookend ending type of point will be constructive additions to a trust that is fully or partially exempt from the GST tax, because we have to know valuation and we have to know grandfather trusts and gallo trusts for that to be an effective discussion. So far, here's a quick rundown of the glossary of the terms we've talked about today. We're adding another one to the list today, and that is a GST Trust. So thank you for joining me for this part 9 of the basics of GST tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for joining me for this video, and I look forward to seeing you in my future content.